Today, we will talk about investing in mutual funds and ETFs. Mutual funds and exchange-traded funds, ETFs, have a lot in common. Both types of funds consist of a mix of many different assets and represent a popular way for investors to diversify. While mutual funds and ETFs are similar in many respects, they also have some key differences. A major difference between the two is that ETFs can be traded intraday like stocks, while mutual funds only can be purchased at the end of each trading day, based on a calculated price known as the net asset value. 1. Diversification benefits. Diversification benefits refer to the advantage of spreading investments across a variety of assets or asset classes, which can reduce the risk of significant losses. Mutual funds and ETFs inherently provide diversification by pooling investor money and investing in a range of stocks, bonds, or other securities. By owning a share of a mutual fund or ETF, an investor effectively owns a proportion of all the underlying assets in the fund, ensuring that the investor's portfolio isn't overly reliant on the performance of a single security or sector. This dispersion can mitigate potential losses and provide a more stable return over time. 2. Professional management. Professional management means that mutual funds and some types of ETFs are managed by seasoned fund managers and a team of analysts. These professionals possess the expertise, resources, and tools to research, select, and monitor the performance of assets within the fund. They make informed decisions based on market trends, economic data, and company performance. For investors who lack the time or expertise to manage their own portfolios, this offers an advantage. They can rely on the skills of experts to optimize returns and manage risks, ensuring that the investments are in line with the fund's objectives and strategies. 3. Automatic investment plans. Automatic investment plans allow investors to contribute a fixed amount of money at regular intervals, monthly or quarterly, to their mutual fund or ETF investments. This systematic approach not only instills a disciplined saving habit, but also enables a strategy called dollar-cost averaging. By investing consistently over time, investors buy more shares when prices are low and fewer shares when prices are high, potentially reducing the average cost per share over the long term. Automatic investment plans reduce the emotional aspect of investing, helping investors avoid making impulsive decisions based on short-term market fluctuations. 4. Liquidity. Liquidity refers to the ease with which an asset can be quickly converted into cash without significant loss in value. Mutual funds and ETFs offer high liquidity as they can be easily bought or sold. In the case of mutual funds, they are traded at the day's closing net asset value, NAV, while ETFs, like stocks, can be traded throughout the trading day at market prices. This flexibility ensures that investors can access their funds or adjust their portfolios relatively quickly in response to personal financial needs or changing market conditions. 5. Low initial investment requirement. Low initial investment requirement means that mutual funds and ETFs often have accessible entry points for investors. Many mutual funds offer initial investment minimums that are affordable, allowing individuals to start investing with a modest amount of money. ETFs, being traded like stocks, can be bought in single share increments, allowing for even smaller initial investments based on the current share price. This makes it feasible for beginner investors or those with limited capital to begin building a diversified portfolio without needing a large sum of money up front. 6. Dividend reinvestment. Dividend reinvestment is a feature offered by many mutual funds and ETFs where dividends or capital gains distributions received by the fund can be automatically used to purchase additional shares of the fund. This automatic reinvestment allows investors to compound their returns, as they earn returns not only on their initial investment, but also on the dividends and capital gains that are reinvested. It's a hands-off approach that ensures any distributions are put right back to work, accelerating the growth of the investment over time. 7. Tax efficiency. Tax efficiency is a notable advantage, especially for ETFs. ETFs often have a more tax-efficient structure compared to mutual funds due to the in-kind creation and redemption process, which helps limit taxable capital gains distributions. while mutual funds might need to sell securities to meet shareholder redemptions, leading to capital gains. ETFs can transfer securities in kind to avoid triggering a taxable event. For investors in taxable accounts, this efficiency can mean potential savings on capital gains taxes, enhancing net returns. 8. Transparency. Transparency ensures that investors are aware of the holdings within their mutual fund or ETF. Most funds disclose their portfolios on a regular basis, allowing investors to see which stocks, bonds, or other assets the fund owns. This level of visibility helps investors understand their exposure to specific sectors, companies, or asset classes. ETFs, in particular, typically disclose their holdings daily, while mutual funds do so quarterly. This frequent disclosure allows investors to make informed decisions and understand the risks and opportunities inherent in their investments. 9. Flexibility in asset allocation. Flexibility in asset allocation means that mutual funds and ETFs come in a vast array of types and styles, catering to various investment objectives and risk tolerances. Whether it's sector-specific funds, international funds, bond funds, index funds, or thematic funds, there's likely a fund that matches an investor's desired asset allocation. This diversity allows investors to easily diversify across geographies, asset classes, or investment strategies, tailoring their portfolio to their financial goals and risk appetite. Whether one is looking for growth, income, capital preservation, or a mix, mutual funds and ETFs offer the tools to construct a balanced portfolio. 10. Low transaction costs. Low transaction costs mean that mutual funds and ETFs often provide a cost-efficient way to access a diversified portfolio. Mutual funds pool money for many investors to buy a broad range of assets, allowing them to benefit from economies of scale, which can translate to lower transaction fees. ETFs, while traded like stocks, often have lower expense ratios than actively managed mutual funds, especially if they track an index. Additionally, some brokerages offer specific ETFs with no trading commissions. For investors, lower transaction costs and fees can lead to significant savings over the long term, enhancing overall returns. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.